The mechanical reality of the global financial system has reached its most dangerous friction point, the moment when the World S ultimate collateral, gold, begins its final vertical ascent to reprice the failures of fiat debt. As of December 20th, 2025, the data confirms that we are no longer in a bull market. We are in a systemic revaluation. Gold has shattered the $4,000 barrier, recently peaking at $4,181 per ounce, a staggering 65% gain in the last 12 months. But the revelation is not the price, it is the velocity. For the first time in history, the world S central banks are not just buying gold, they are front-running the collapse of the dollar-based reserve system. When institutions like JP Morgan and Goldman Sachs simultaneously raise their targets to $5,000 and beyond for 2026, they are not making a prediction. They are acknowledging a mathematical inevitability. The machine is repegging itself to reality, and the $5,000 mark is the first milestone of the Great Reset. Check. Phase 1. The sovereign scarcity, the 2025 foundation. To understand the 2026 landscape, you must recognize the four-stage pattern of the sovereign debt reset. Stage 1 is the foundation of scarcity, which reached its climax in 2025. According to the World Gold Council's December 2025 data, central bank gold buying hit a record 1,313 tons in the third quarter alone, a 50% increase over the previous year. But here is the systemic anomaly. They are buying at record high prices. Historically, central banks are value buyers who wait for dips. In 2025, that behavior changed. Institutions like the National Bank of Poland and the Central Bank of Brazil have become price insensitive. They are moving out of US treasuries and into gold at any cost because they see the interest rate conflict is terminal. When the US debt servicing costs hit $1 trillion annually, as they did in late 2025, the dollar ceases to be an asset and becomes a liability. Gold is the only exit. Verified. Phase 2. The unit, and the BRICS wedge, the catalyst. We have now entered Stage 2, the institutional alternative. On December 18, 2025, reports surfaced of the unit, a new digital settlement asset being tested by BRICS nations. Unlike previous attempts at de-dollarization, the unit is underpinned by a basket that is 40% physical gold. This is the wedge. It creates a parallel non-Western financial system where trade is settled in an electronic representation of gold rather than the greenback. As the US unemployment rate rose to 4.6% in November 2025, and the Federal Reserve was forced to cut rates to 5.25% to prevent a recession, the yield gap closed. In a world of falling rates and rising debt, the opportunity cost of holding gold vanishes. The BRICS nations aren't just buying gold for their vaults, they are using it as the primary liquidity engine for a world that no longer trusts the SWIFT network. Phase 3, the 1% shift, the 2026 vertical. This leads us to Stage 3, the portfolio migration. This is the phase that will define 2026. Goldman Sachs' latest Mathematics of Gold report identifies a terrifying reality for the bond market. Private ownership of US treasuries is currently valued at roughly $57 trillion. If global investors move just 1% of that capital into the gold market, a market that is tiny by comparison, it would inject over $570 billion in new demand. As of December 2025, gold accounts for only 2.8% of global assets under management, AUM. JP Morgan predicts this share will rise to 5% by the end of 2026. This is the wall of money that makes $5,000 an easy target. When the smart money, the hedge funds, corporate treasurers like Tether and family offices, realizes that gold is the only secular critical asset left, the price will go vertical. We are seeing the death of the 60-40 portfolio and the birth of the gold-weighted era. Check. Phase 4. The neo-feudal reset, the endgame. History confirms that every time a global reserve currency hits the 100-year mark, it undergoes a voluntary or involuntary revaluation against gold. 1933. The US devalued the dollar from $20 to $35 against gold to inflate its way out of the Great Depression. 1971, Nixon closed the gold window when the dollar-S supply far exceeded the gold backing. 2026, the digital reset will attempt to move the world into CBDCs, but the real world will only accept CBDCs if they are backed by a kinetic standard, gold. The systemic revelation is that the $5,000 gold prediction is not about gold getting it more expensive. It is about the dollar reaching its terminal value. In 2026, the machine will shed its paper skin. The elite are already buying the weird assets, private gold mines, subterranean rights, and physical bars, while the public is sold digital claims, verified. The friction point warning. Dismiss the idea that this will be a smooth ride. As gold approaches $5,000, we will see extreme equity market volatility. Gold is a hedge against a sharp correction in stocks. In late 2025, as the S&P 500 struggles with earnings visibility, investors are parking capital in gold. If the equity bubble pops in 2026, gold will be the only source of liquidity. This is the liquidity trap. When everyone tries to sell their stocks to buy gold at the same time, the price of gold doesn't just rise, it gaps. Undeniable. Actionable. Insight: do not wait for the $5,000 headline to position yourself. The early movers are already deep into stage 3. De-financialize, move a portion of your wealth into physical gold held outside the banking system. If it's on a screen, it's a permission-based asset. Watch the ratio. As gold heads to $5,000, keep your eye on the gold to silver ratio, currently at 65:1. Historically, in a reset, this ratio crashes to 15:1. Tier 1 miners. Look for companies with in situ reserves, gold still in the ground that hasn't been mined yet. In a $5,000 gold environment, these companies become the new central banks of the private sector. The machine is accelerating. The $4,181 record of December 2025 is the final exit sign. In 2026, the golden constant will return to its throne, and those holding paper will be left with the narrative, while those holding gold will hold the future. Watch our next analysis, the 2026 BRICS currency launch, the day the dollar died. To understand the specific triggers for the final repeg, subscribe to the revelation. The pattern is absolute. The mechanical reality of the $5,000 gold prediction is not a speculative target. It is the mathematical outcome of a system that has officially run out of ways to devalue its debt without devaluing its currency. As of late December 2025, the data confirms that gold has entered the vertical escape phase. The 4-stage pattern of the sovereign debt reset is now completing its final arc. Stage 1, the quiet accumulation, 2020-2023, saw central banks quietly become net buyers for the first time in decades. Stage 2, the strategic diversification, 2024, early 2025, was defined by the BRICS nations and emerging markets shifting out of US treasuries and into physical metal at an accelerated pace. Stage 3, the institutional FOMO, late 2025, is where we are now. Major institutions like Tether and global family offices are moving billions into gold as a core diversification asset, shifting allocations from 2% to 10% of total assets under management. Finally, stage 4, the vertical repeg, is what we will witness in 2026. This is the stage where the price does not just rise, it gaps upward as the paper gold market collapses, and everyone demands physical delivery at once. Verified. To prove the inevitability of the $5,000 mark, we look to the 1979 gold mania. Stage 1, years of persistent inflation and energy shocks. Stage 2, a loss of confidence in the dollar following the end of Bretton Woods. Stage 3, the friction point, where the market realized the Federal Reserve was behind the curve. Stage 4, gold went from $200 to $850 in a single year, a 4x increase. In today's terms, with the massive expansion of the M2 money supply since 2020, the 2026 outlook is driven by the debt-to-asset siphon. As interest rates remain restrictive to combat the inflation of 2024 and 2025, the cost of servicing the $36 trillion US national debt has reached a critical threshold. In late 2025, the US government is paying over $1 trillion a year in interest alone, more than the entire defense budget. This is a black hole for capital. As the market realizes the government must eventually print money to pay the interest on the money it already printed, the faith and credit of the dollar evaporates. Gold at $5,000 is simply the market's way of saying the dollar has lost 95% of its 1971 purchasing power. Undeniable. Dismiss the notion that high prices will deter buyers. In a stage 4 reset, buyers become price insensitive. In November 2025, central banks added another 244 tons to their reserves despite record highs. They aren't trading gold, they are securing their survival. For a nation like China or India, holding gold is not about profit, it is about having a seat at the table when the new global currency unit is launched. This new BRICS-led settlement asset, reportedly backed by 40% physical gold, is the catalyst that will break the dollar AS back in early 2026. When the I-unit becomes the primary tool for oil and commodity trade, the demand for gold will not just increase, it will explode. Verified. The systemic revelation is that the $5,000 gold prediction is the final alarm clock for the middle class. If you are waiting for a pullback to the 2000s, you are waiting for a world that no longer exists. The easy money era is dead, and the hard money era has returned. The machine is moving wealth from those who hold claims on value, bonds and cash, to those who hold an actual value, gold and silver. In 2026, the gap between the two will become an unbridgeable chasm. Check. Actionable insight. Stop looking at the price in dollars and start looking at the gold to S&P 500 ratio. When gold is cheap, the ratio is high. When gold is revaluing, the ratio collapses. We are currently in the early stages of a historic ratio reset. Position yourself by converting paper wealth into kinetic wealth. If you don't hold the physical metal in a secure, non-bank jurisdiction, you are still at the mercy of the machine's delete button. The $5,000 mark is just the beginning of the end of the fiat experiment. The era of the golden constant is back. Watch our next analysis, the 2026 silver squeeze. Why $100 silver is closer than $5,000 gold, to see the explosive leverage hidden in the gold to silver ratio. Subscribe to the revelation. The pattern is absolute. The mechanical reality of the $5,000 gold prediction is not a speculative target. It is the terminal output of a financial system that has officially run out of ways to devalue its debt without devaluing its currency. As of late December 2025, the data confirms that gold has entered the vertical escape phase. The four-stage pattern of the sovereign debt reset is now completing its final arc. Stage 1, the quiet accumulation, 2020-2023, saw central banks become net buyers at rates not seen in half a century. Stage 2, the strategic diversification, 2024, early 2025, was defined by the BRICS plus nations moving away from US Treasuries. Stage 3, the institutional FOMO, late 2025, is our current location. Major institutions and exchange-traded funds, ETFs, are seeing record inflows, averaging 585 tons per quarter, as they pivot from growth to preservation. Finally, Stage 4, the vertical repeg, is the 2026 outcome. This is where the price doesn't just rise, it gaps upward as the paper gold market faces a physical shortage. Verified. The debt-to-asset siphon. To prove the inevitability of the $5,000 mark, we look at the siphon effect of US debt. The milestone. In late 2025, US national debt surpassed $38 trillion, the velocity. The jump from $37 trillion to $38 trillion took only 71 days. The friction. For the first time in history, annual net interest payments on that debt have surpassed $1 trillion. The US government now spends more on interest than it does on national defense or Medicaid. Every dollar of tax revenue is being devoured by the ghost of previous spending. In a Stage 4 reset, the market realizes that the only way to pay the interest on the debt is to print more money, which further devalues the currency. This creates a feedback loop that drives gold higher. In late 2025, gold accounts for only 2.8% of global assets under management. If global diversification shifts just 0.5% more into gold, the BRICS unit catalyst dismissed the notion that high prices will deter buyers. In a Stage 4 reset, buyers become price insensitive. As of December 2025, the BRICS Plus group, now including Indonesia and Saudi Arabia, is moving forward with a unit. This new digital settlement instrument is reportedly backed by a reserve basket consisting of 40% physical gold. While the West focuses on retail consumerism, the East is building a kinetic standard. By anchoring their trade platform in gold, these nations are creating a parallel financial system that bypasses the dollar's inflation. In November 2025 alone, global gold demand hit a record 1,313 tons, driven by central banks that aren't looking for profit, but for a seat at the table when the dollar is no longer the sole reserve currency. The $5,000 gold prediction is the signal that the unit of account is shifting. Verified. The systemic revelation. The systemic revelation is that gold at $5,000 is not gold getting expensive. It is the dollar reaching its terminal value. When you measure gold against the cost of living, $5,000 gold in 2026 will buy roughly what $2,000 gold bought in 2020. The gold prediction is actually a currency devaluation prediction. The machine is currently stripping the purchasing power from your savings to pay for the trillion-dollar interest cycle. History proves the pattern. Look at 1979, Stage 1. Inflation led to a Stage 4 spike where gold went from 200 to 850 in months. We are seeing the same pattern today, but with a debt-to-GDP ratio that is 3x higher than it was in the 1970s. The tension in the spring is far greater now than it was then. Check. Actionable insight. Position for the gap. Stop measuring your success in a currency that has a 100% chance of further devaluation. Position yourself by focusing on the hard asset firewall. 1. Ownership versus claims. If your gold is in an unallocated bank account, you don't own it. You own a claim that can be settled in devalued cash. Physical possession is the only stage 4 protection. 2. The ratio play. Watch the gold to silver ratio. As gold heads toward $5,000, silver, currently at $67.15, is positioned to move even faster. 3. Tier 1 selection. Focus on stage 3 miners, who are already seeing their earnings explode as the spot price leaves their production costs in the dust. The machine is accelerating. The $4,838 record of December 20th, 2025 is the final warning shot. In 2026, the $5,000 barrier will not be a ceiling, it will be a floor. Don't be the one left holding paper when the world returns to the golden constant. Subscribe to the revelation. The pattern is absolute. This script follows the systemic revelation formula, integrating the historic data as of December 20th, 2025. It tracks the final vertical ascent of the world's ultimate collateral, gold. The $5,000 gold. Prediction: the final repeg. The mechanical reality of the global financial system has reached its terminal friction point, the moment where gold ceases to be a commodity and resumes its role as the final arbiter of value. As of December 20th, 2025, the data confirms we have entered the vertical escape phase. Gold prices have just touched a historic peak of $4,138 per ounce, marking a year-to-date surge of over 65%. This is not a rally or a speculative bubble. This is a structural repricing. When JP Morgan and Goldman Sachs simultaneously upgraded their targets this month to $5,055 per ounce for late 2026, they were acknowledging a mathematical certainty. The debt to GDP ratio has reached a point where the only way out is a massive devaluation of the dollar against the golden constant. The machine is repegging itself to reality. Check. The 4 stages of the sovereign debt reset. To navigate the 2026 landscape, you must recognize the 4-stage pattern of the sovereign debt reset. Stage 1, the quiet accumulation, 2021-2023. Central banks became net buyers at a pace not seen in 55 years, quietly draining the vaults while the public was distracted by paper stocks and crypto volatility. Stage 2, strategic diversification, 2024, early 2025. Emerging markets, led by the BRICS Plus alliance, began aggressively shifting out of US Treasuries and into physical gold, sensing the interest rate trap. Stage 3, the institutional siphon, late 2025. This is our current location. Major institutions, including pension funds and corporate treasuries like Tether, are moving from a 1% gold allocation to 10%, creating a massive demand vacuum. Verified. Stage 3, the vertical repeg, 2026. This is the outcome. This is where the price does not just rise, it gaps. As the paper gold market in London and New York faces a total physical delivery failure. The $1 trillion interest trap. The primary engine driving gold to $5,000 is the debt-to-interest siphon. On October 23, 2025, the U.S. national debt hit a historic milestone of $38 trillion. But the price of gold is not reacting to the debt itself. It is reacting to the cost of that debt. In late 2025, net interest payments on the U.S. debt surpassed $1 trillion annually for the first time in history. Interest is now the second largest federal expense, surpassing both national defense and Medicare. The government is now borrowing money simply to pay the interest on the money it already borrowed. This is a fiscal doom loop. In a stage 3 reset, the market realizes that the central bank must eventually lower rates to keep the government solvent, which will trigger hyperinflation. Gold at $4,338 is the market's preemptive strike. At $5,000, it is the market's declaration that the dollar has reached its terminal phase. Undeniable. The BRICS unit and the de-dollarization wedge dismiss the idea that high prices will deter buyers. In a stage 3 reset, buyers become price insensitive. Just 12 days ago, on December 8, 2025, the BRICS Alliance officially launched the pilot for the unit, a gold-anchored digital trade instrument designed to settle trillions in trade outside the Western banking system. The unit is reportedly backed by a reserve basket that is 40% physical gold. This is the wedge that breaks the dollar's monopoly. For the first time since 1971, a major global trade bloc is treating gold not as a dead asset, but as active collateral. As 30-plus countries move to settle trade in units, the global demand for gold is projected to average 585 tons per quarter through 2026. This is the structural bid that makes the $5,000 prediction not only possible, but inevitable. Verified. The systemic revelation. Ownership versus claims. The systemic revelation of 2026 is that the $5,000 gold prediction is actually a paper gold default prediction. Currently, for every 1 ounce of physical gold in the vaults, there are over 100 ounces of paper claims traded in the futures markets. As the price nears $5,000, the smart money will stop settling for cash and start demanding physical bars. When the vaults go empty, the price will teleport to the triple digits in hours. The machine is moving from a system based on trust in debt to a system based on trust in collateral. If you don't hold the kinetic asset, you're merely a creditor in a system that is planning a default. Check. Actionable insight. The hard asset firewall. Stop measuring your wealth in a currency that is losing 10 to 15% of its real purchasing power annually. Focus on the tangible to debt ratio. Direct ownership, avoid paper. Gold ETFs that can be settled in cash during a force majeure event. Hold physical bullion or use private vaulting outside the domestic banking system. The gold is silver bridge. As we analyzed in the silver skyrocket, silver at $67.48 is currently outperforming gold on a percentage basis. Use gold for wealth preservation and silver for wealth acceleration. Tier 1 allocation. Target the 2026 miners who have in situ reserves. Gold still in the ground that is currently being repriced by the market in real time. The machine is accelerating. The 4,330 Aler record is the last exit sign before the $5,000 era begins. Don't be caught holding a digital wallet of access when the world returns to the golden constant. Watch our next analysis, the 2026 silver squeeze, why $100 silver is now the base case. To see the explosive leverage hidden in the ratio, subscribe to the revelation. The pattern is absolute.